Good afternoon. Let's begin with the Fed and the word not patience, but solid. The Fed announcing that economic activity has been expanding at a solid pace. That's an upgrade, folks, from the previous word that was used, moderate. I've also heard modest, but when I heard solid, I said, whoa, why is the market jumping? Because initially it did start moving much higher, and then maybe the word solid started to sink in. And what is interpreted from that word? What will put the most pressure on the Fed policy right now? Is it the dollar, disinflation, Draghi, or European monetary policy? We have all-star lineups here. Joining us now, the guy who pressed the send button the second that report was out, John Hilsenrath, the Wall Street Journal chief economic correspondent. We have Broaddus, former Richmond Federal Reserve president. Keith Bliss on the floor of the New York Stock Exchange. You see Chris Gersch there. He's in Chicago. Phil Flynn as well at the CME. John and Al, I want to begin with you right off the bat, John. That word solid, am I misinterpreting that? I looked at that and said, the market might not like that term because it's more positive.
No, I agree. I think you would think the market would like it when the central bank is saying the economy is growing at a solid pace. Yes. You know, I'm picturing Janet Yellen fist bumping her colleagues there, talking about solid. But yeah, I mean, so this is where the Fed is right now. They see an economy that's doing pretty well. They see in a job market that's really picked up pace. But there are a couple of areas that they're worried about, which they also pointed to in the statement. One of which is falling inflation expectations, and the other is international developments. So they're confident about the economy, but they're a little nervous about those developments. And this is what they're going to be debating now as they go into their next meeting in March and decide whether June is actually on the table. I think the market maybe was discounting that June wasn't going to happen, and now they're saying, hey, maybe it is going to happen.
Well, I think you're right, and that was in, the first or second paragraph of your article for the Wall Street Journal Online. Let me get to Al. You've been on the inside of these meetings, Al. Right off the bat, what was the surprise for you?
Well, I think you're both right that the strength of the characterization of the general economy was, the word solid's a strong word, and that conveys a lot to me. And it was a little bit stronger than I would have anticipated. I think the one thing I would add, and John alluded to this, is I think you had really an equally dramatic underlining with respect to their worries about the low inflation as well. They pointed out that the market-based measure of inflation expectations has been down sharply. They used, I don't remember the exact wording, but it was stronger than we'd seen. So it seems to me that you got almost a balance here. You have a stronger push on the upside with regard to the general economy, but a stronger downside push with regard to inflation.
To the traders, I want to hear your response. Keith, I'll start with you because right off the bat, you know, I always write down the second before the statement's released, I write down where the markets are. The Dow, for all intents and purposes, we'll use that one, was up 38 points. The report comes out, no rate hike for the March or April meetings. The Dow moves higher. We can show an intraday chart here. Same with the NASDAQ, same with the S&P. And then I'm hearing the word solid, right? Al just said it sounded a lot stronger than expected. The market wants to know that there's going to be quantitative easing or at least a much more dovish policy for a long time. And I thought, that's not dovish. Tell me what the traders were thinking.
Well, exactly the same thing as John's pointing out. I think most people, including myself, were thinking that September earliest for a rate hike, despite what the noises or the statements may have been in prior months. But once they came out with what I thought was kind of a mixed message inside of that statement, sure, there was the word solid, there was the word strong when you talk about job growth, but they also included patient in there. And I think it was John who wrote very soon after that said patient implies that it will be at least 2 more policy meetings before they would even contemplate raising rates. So that'll take us out to June for sure. But right now the equity market's in a state of confusion. It's almost like we're juggling balls of confusion right now and trying to decipher all these data points and these noises coming out. So we'll have to see how the data trends in the next couple of weeks. I thought what was very interesting, though, as soon as they saw inflation expectations are not as high as they expected, you saw the TIP, the Treasury Inflation Protected Security, just start selling off right away.
I noticed that.
And that's indicative. Yeah.
Well, Chris, talk to our viewers who are retail investors and what they should interpret from this and what you saw in the pits at the CME.
What I saw in the pits of the CME was just the sheer volatility. I think a lot of traders assume that there'd be stronger comments actually towards lowering that 2% handle mark as a target for inflation. I thought a lot of traders assumed that they would actually make a revision to that amount and actually cause a little bit of concern for possibly raising rates a little bit higher. You saw the initial move to the upside, and immediately on my trade desk, the traders had a little gasp as it went right through their bids to the downside. So what this means to the retail traders is try to stay out of these Fed announcement days. Make sure that you're making your decisions. Read through those. And the best way to do this, if you're hedging risk, sticking to those ETFs that traditionally you will have a aggregation of all these different funds. Right now, the equities seem to me on our desk to be an excellent place. The risk-off situation is on right now as we're seeing it bounce up a little bit from those lows.
Well, so let me jump to Phil Flynn, because there is some news ex the Fed, and that's in oil land. We saw a much bigger than expected build in inventories last week for oil. That comes out. Suddenly oil drops to a 6-year low, a new one. Look at this chart here. And we're in the aftermarket session now. But conversely, we saw retail gasoline up for the first day in 120 days. It's lower now. But what do you think?
The party's over. It's time to call it a day. Hey, we followed every day since September. We're due for an update on gasoline prices, and we actually have seen prices gone up. But listen, oil is a microcosm of the Fed's problem. They have a 2% problem, and these oil prices, even if they rebound, which I think they will at some point, is not going to solve the problem. And it's not just the low oil prices. It is the larger deflationary pressures that we're having, and I think that's why the Fed is in such a bind here right now. They want to say the economy's getting better. They're seeing the numbers get better. Consumer confidence. But at the end of the day, they have a deflation problem. And by raising rates, it's only going to make it worse. The deflation pressures are starting to impact earnings here in the U.S. Unless you're buying an iPhone or that kind of thing, the companies are starting to feel this pain. And while the economy is solid right now, if the Fed starts raising interest rates, the dollar continues to rise, we continue to see this deflation, the economy is not going to stay solid over the long run.
Okay, that brings me back to John Hilsenrath, though. Doesn't Janet Yellen have to map a plan? Does she not, John, really have to look and say, I need to course out this, map that course of interest rate tightening?
Well, she absolutely does, and I think that's a lot of what they were doing in the last couple of days. And so actually, let me give you a little bit of the roadmap for the next couple of months, because we have some very important milestones that we're going to be going through. It starts this Friday when the Labor Department's going to be reporting new data on labor costs, the Employment Cost Index. The Fed is looking to see if lower unemployment is pushing up, creating wage pressures. Then next week, we get a jobs report, which is going to be very important. And then later in February, Yellen is going to be testifying in front of the Senate and the House, and she'll be giving new signals. And then this is all leading up to March. The Fed has a policy meeting in mid-March, and that's when they've got to decide if they take patient off the table. It means that June is really, seriously being considered. If they leave patient on the table, then nothing happens until the second half of the year.
I really do want to get this from somebody like you. Of all of the Ds we've talked about, the U.S. dollar, deflation, U.S. data, whether it's strong or weak, or Mario Draghi, which one is pressuring Janet Yellen the most?
Well, I think all of them. It puts some pressure on her. But let me go back and just address this question. The focus now is on expectations regarding whether the Fed will or will not lift off at the June meeting. And John is right that the March meeting and the decision there will give us a new line on that, and it will depend on data. But the feeling seems to be that this immediate market reaction has been one that suggests markets, at least for the moment, think that the probability of a liftoff in June has been increased by the use of this solid language. And that may be true. I guess my own view is that given the inflation language that I referred to a couple of minutes ago, seems to me, I don't feel that the probability, given what we know now, has changed a lot. And I guess I still think it's fairly unlikely that we'll see a move in June, given all of the downside information about inflation. I think the consensus that they're going to move sooner rather than later is weaker than it was. I noticed that my successor in Richmond, who's quite a hawk, did not dissent at this meeting today. So all of those things make me think that they're in a hold position.
Okay.
And we'll see what comes in between now and March, and then see what they do in March.
Al, you worked with Janet Yellen in the FOMC, and you debated her on inflation. What do you think she wants to do? What do you think her gut's saying
Good
right
question,
now?
Yeah.
John, I think that the Fed would very much like to get on with it and get liftoff done and begin to move back towards normalization. But I do think that they will be constrained. And, they have an inflation target. I don't think that's going to change. It's 2%. They're way below it. And I think that's going to be a constraint on the speed with which they move.
Okay.
No doubt they would like to normalize, but I think with the latest news seems to me, we know that the inflation data may be transitory.
Okay.
But still, I think it's strong enough and overwhelming enough. It's going to be a sort of a rein on this.
Well, I'll tell you what's overwhelming, gentlemen. Now the Dow is down 32 points. So much for being, buoyed by what happened with the report. I'm saying the word solid is definitely affecting this. Our thanks to all our traders weighing in. Again, the only index that's clinging to the upside barely, and it's almost flat now, is the NASDAQ. S&P's turned negative, same with the Russell 2000, and of course the Dow. Thanks to John Hilsenrath of the Journal. Broaddus, former Richmond Fed Reserve President. Keith, Chris, and Phil, good to see you. Close.